Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Briefing, April 29, 2026. This video presents a direct informational narration of the source document. Okay, let's dive right into today's explainer.
Today's agenda covers 5 key areas: geopolitics and energy markets, the Federal Reserve decision, big tech earnings, market breadth, and finally, sector performances. Starting off with Section 1, Daily Market Overview. On Wednesday, April 29th, the market displayed a very cautious wait-and-see sentiment. With surging oil prices and impending major tech earnings on the horizon, the S&P and NASDAQ basically closed flat, while the Dow Jones Industrial Average posted slight declines. Overall, declining stocks actually outnumbered advancing ones. Now, AI hardware completely maintained its strength, but software faced renewed pressure. We also saw broad weakness in the industrial sector, with Boeing really leading the decline among the Dow components. Conversely, the credit sector performed exceptionally well, driven by a massive post-earnings surge in Visa's stock price.
Moving on to Section 2, Geopolitics and Energy Markets.
International oil prices absolutely surged, hitting $108 a barrel intraday. According to Axios, Trump rejected a proposal from Iran and announced intentions to continue blockading the Strait of Hormuz. The U.S. Central Command is actually prepared to launch a short-term strike against Iran, and Trump made it clear, if Iran fails to take action, he will consider military measures. He even posted that Iran cannot reach an agreement and needs to get smart quickly, attaching a photo stating, "No more Mr. Nice Guy."
In response to all this, Iranian officials stated that their willingness to talk was basically an opportunity for the U.S. to understand and accept conditions for permanently ending the war, noting that the current ceasefire gives Trump a chance to lead the U.S. out of the conflict. But they warned that if the U.S. continues to blockade Iran and seize ships, they will take unprecedented military action. Despite this escalating rhetoric, the market views this mostly as a negotiation tactic, recognizing that the tactical cost of fully resuming military strikes is much higher now than at the start of the ceasefire. Plus, after hours, Trump posted again, indicating ongoing phone communications with Iran, suggesting negotiations could just occur directly by phone without the need for long flights to hold meetings. But a more significant driver of the oil price increase was actually the U.S. EIA crude oil inventory. It dropped by a staggering 6.23 million barrels last week, far exceeding expectations, especially following an increase of 1.925 million barrels just the previous week. Concurrently, the U.S. Strategic Petroleum Reserve, or SPR, hit a one-year low, which definitely reignited supply concerns. Let's look at Section 3, the Federal Reserve decision. Right at 2 p.m., the Federal Reserve released its interest rate resolution statement. Exactly as anticipated by the market, the FOMC maintained interest rates unchanged. Their statement indicated that recent indicators show economic activity expanding at a solid pace. However, job gains have remained low on average, and the unemployment rate has shown little change in recent months. Inflation remains stable, which partly reflects those recent increases in global energy prices we just discussed. Following the statement, U.S. Treasury yields briefly rose, decreasing the probability of rate cuts in 2026, and U.S. stock indices edged lower. Half an hour later, Powell began his speech. The key takeaway here was his announcement that he will remain a Federal Reserve governor for a period after stepping down as Fed chair, departing when the time is right. The market reacted very calmly to this, as he committed to keeping a low profile during his tenure as governor, explicitly stating he will not act as a shadow chair or voice public opposition. With Warsh set to take office in May, this is highly likely Powell's final press conference. Therefore, the impact of this Fed meeting and Powell's speech on the market was pretty limited. The Goldman Sachs trading desk viewed the FOMC as a low volatility event, noting that the market is way more focused on the Iran situation, corporate earnings, and end-of-month factors. They also observed that risk assets have largely discounted the Iran conflict's impact, meaning we might be potentially underestimating the downside tail risks.
Which brings us to Section 4, Big Tech Earnings Breakdown. After hours, several tech giants released their earnings. Microsoft reported fiscal third-quarter revenue of $82.9 billion, an 18% year-over-year increase, with adjusted earnings per share at $4.27, up 23%. Azure and other cloud services grew by 40%, totally beating expectations of 38%. Commercial remaining performance obligations nearly doubled, growing 99% year-over-year to $627 billion, which provides a wonderfully solid revenue stream for the coming years. However, the stock price spiked and then retreated after hours, turning a 4% gain into a decline. Why? Because investors noted that Q3 capital expenditures reached $30.9 billion, an 84% year-over-year surge, heavily pressuring cash flow. Despite strong operating cash flow growth, free cash flow actually decreased by 22% year-over-year. This illustrates that observing revenue and profit growth alone is insufficient. The amount of free cash flow generated is absolutely critical. Then we have Google. They reported Q1 revenue of $109.9 billion, up 22% year-over-year. Advertising revenue was $77.25 billion, surpassing expectations of $76.2 billion. Google Cloud revenue reached $20 billion, up 63%. Earnings per share were $5.11, up 82%, significantly beating expectations of $2.67. First quarter Alphabet Gemini Enterprise monthly active users grew 40% quarter-over-quarter. Q1 capital expenditures were $35.67 billion, slightly below the expected $36.39 billion. Google Cloud backlog reached $460 billion, up 63%. Google generated $10 billion in free cash flow this quarter, representing a 47% decrease. Although capital expenditures will rise further, the company can still generate free cash flow, supporting an after-hours stock price increase and opening room for further upside. Meta's Q1 revenue was $56.3 billion, a 33% year-over-year increase. Net income was $26.77 billion, with EPS at $10.50, up 62%. Free cash flow stood at a healthy $12.39 billion, and Q1 capital expenditures were $19.84 billion. The company projected Q2 revenue between $58 billion and $61 billion, with the midpoint of $59.5 billion meeting expectations perfectly. Despite these incredibly strong figures, the stock fell significantly after hours. The reason? The company raised its 2026 capital expenditure guidance from a range of $115 to $135 billion up to $125 to $145 billion. While the spending is undeniably high, the strong growth in revenue, profit, and free cash flow presents a fundamentally solid picture. Amazon's Q1 net sales were $181.5 billion, up 17% year-over-year. EPS was $2.78, vastly exceeding expectations of $1.62. AWS Q1 net sales were $37.6 billion, beating expectations of $36.68 billion, up 28%. Q2 net sales guidance is $194 to $199 billion, also beating expectations. Q1 net income reached $30.3 billion, up from $17.1 billion last year. However, a significant portion of this is paper gain, not from core operations. This money comes from Amazon's investment in the AI company Anthropic. It's classified as non-operating income, which the market typically discounts. Regarding cash flow, operating cash flow for the trailing 12 months was $148.5 billion, up 30%. But full-year free cash flow plummeted to just $1.2 billion, compared to $25.9 billion a year ago. Why? Because capital expenditures surged by $59.3 billion, entirely allocated to AI infrastructure. Free cash flow for the specific quarter was a negative $18 billion. The surface-level earnings mask massive AI spending, leading to an after-hour stock drop.
Now let's explore Section 5, Market Breadth and Dow Divergence.
As investors continue to digest these tech earnings, the broader market is showing some hesitation. The S&P 500 posted a small doji for 2 consecutive trading sessions, caught right between the 5-day and 10-day moving averages, indicating hesitation among short-term capital before the earnings. Goldman Sachs warned that pension fund end-of-month rebalancing will bring about $23 billion in selling pressure on the last trading day of April. While this scale won't dictate market direction, it will definitely amplify it. The Dow Jones has been notably weak recently, failing to hit new highs alongside the S&P and NASDAQ, and instead pulling back early. This FOMO rally has been driven by AI and semiconductors, and the Dow simply lacks these high-purity tech giants. The Dow consists largely of industrial, banking, traditional energy, and consumer stocks, which are all highly sensitive to high interest rates. With the 10-year Treasury yield at 4.4% and market expectations of rates staying higher for longer, traditional value stocks have prematurely pulled back to compress valuations, while tech stocks are supported by AI expectations. This divergence, the S&P hitting new highs while the Dow lags, is seen by technical analysts as a typical late-stage bull market divergence. It reflects capital retreating from the broader real economy into a few highly profitable tech safe havens, leading to deteriorating market breadth. the S&P Equal Weight Index was actually fallen for 7 consecutive days. For the bull market to continue, a healthy capital rotation into the Dow is completely required, either through improving inflation data confirming a rate peak or capital flowing into the Dow for safety. Observing whether the Dow finds support around 48,000 points is critical for assessing if this bull market can survive through mid-2026. If it falls through this support, the highs of the S&P and Nasdaq become very precarious.
Let's check out Section 6, Semiconductor and Sector Action.
In specific stocks, memory leader STX really ignited sector sentiment. Despite an intraday pullback, it surged 11.1%. Fiscal Q3 revenue grew 44% year-over-year, EPS doubled to $4.10, and free cash flow reached a 10-year high of $953 million. The company is actively deleveraging, paying down $641 million in debt this quarter, and issued next quarter guidance exceeding expectations. The CEO stated the memory industry has entered a new era of structural growth, raising multi-year annual growth targets to at least 20%, with capacity locked until the end of 2027. NXP Semiconductors also delivered strong results and guidance, driven by a recovery in auto and industrial chip demand, causing its stock to soar 25.6%. Q1 revenue grew 12% and net income surged to $1.12 billion. This signals a recovery in industrial and auto chips, with competitors like Texas Instruments and ST Microelectronics also reporting better than expected results, indicating demand is broadening beyond pure AI to physical infrastructure and manufacturing.
Over in the fintech sector, Robinhood shares fell 13.24% today, reflecting a broader drop in the sector. SoFi's earnings beat expectations, with Q1 net revenue up 41% to $1.09 billion and adjusted EPS doubling to 12 cents. However, its Q2 revenue guidance of $1.11 billion was slightly below expectations of $1.12 billion, and it did not raise full-year forecasts, raising concerns about stalled growth. The stock gapped down, dropping 15.4%. These fintech stocks may only recover when the market resumes speculating on rate cut expectations. Meanwhile, AA data shows the national average gasoline price has risen to $4.18 per gallon, the highest since August 2022. This challenges April CPI expectations and totally explains the surge in Treasury yields.
Visa shares surged after earnings. Fiscal Q2 revenue grew 17% year-over-year, the largest increase since 2022, and adjusted EPS of $3.31 also beat expectations. Consumer and corporate payment demand remains incredibly steady, particularly among high-income earners for spending, travel, and commercial payments. Despite macro uncertainties and high oil prices, U.S. March consumer data exceeded expectations. The company unexpectedly raised its fiscal 2026 earnings guidance, and coupled with stablecoin settlement expansion and a new $20 billion buyback plan, market bullishness increased. Short-term support comes from Visa's traditional moat: scale, transaction stickiness, and high-income consumer resilience.
Intel stock hit a new all-time high, doubling in a single month. Media reports suggest Apple is evaluating assigning M-series chips to Intel. Google is considering using Intel's EMIB advanced packaging for the next-generation TPU V8, and Tesla has confirmed it will use Intel's next-generation 14A process at its Austin Terafab AI complex. While terms like evaluating and considering are obviously ambiguous, they totally fuel hot money speculation. With explosive AI chip demand and TSMC's capacity insufficient, Intel's positioned as an unavoidable option supported by its strategic status. However, questions do remain about Intel's capabilities, given past discontinued tests of its 18A process by Apple and NVIDIA.
Fuel cell company BE saw its stock skyrocket 27.2% to a new high after beating Q1 expectations and significantly raising full-year guidance. Q1 revenue was $751 million, up 130%, and it turned a profit of $70.65 million compared to a net loss of $238 million last year. The company raised its fiscal 2026 revenue guidance to a range of $3.4 to $3.8 billion and stated that revenue is constrained only by the speed at which customers build data centers, not by production capacity. You see, fuel cells offer distributed energy that can be installed directly at data centers. This bypasses the 5 to 10-year grid connection approvals required by traditional public utility stocks like VST, which has been consolidating due to its reliance on large grid transmission and high interest rate pressures. Qualcomm released earnings after hours, reporting a 3% decline in fiscal Q2 revenue, but a massive 162% increase in net income to $7.37 billion. However, Q3 revenue guidance of $9.2 to $10 billion and adjusted EPS guidance of $2.10 to $2.30 both missed expectations.
The stock initially fell but then rose as the CEO indicated smooth progress on a custom chip project with a top hyperscale cloud vendor, which is expected to begin shipping this year, and noted that the smartphone market has nearly bottomed out and will rebound in the second half of the year. Finally, Bill Ackman's Pershing Square completed a dual listing, but its debut completely faltered. The IPO utilized a dual structure, including the closed-end fund Pershing Square US and asset management firm Pershing Square, raising $5 billion, with $2.8 billion from cornerstone investors. Priced at $50 with 1 share of PSU given for every 5 shares bought, it broke the issue price on the first day, dropping 16% at the open and closing down 18.2%. The IPO aimed to democratize capital and attract retail investors through partnerships with Robinhood and Schwab. The cold market response is primarily due to the discount trading risks inherent in closed-end funds. And with that, what are your thoughts on all these massive shifts? Let us know in the comments below. Thanks for watching, and we'll see you in the next Explain It.